Hello and welcome to the Week in Markets. I'm joined here by Matt Henderson, Portfolio Manager. It's been a good week for equity markets. We continue to see equities rebound after their lows in the first week of April. If we look at returns, US equity markets are up about 12.5% since their low post-Liberation Day on the 8th of April. So that's about just short of 9% off its all-time high. We continue to see strength also in global equities, like of UK, European equities, which is all encouraging. Bond yields are lower over the month as well. Matt, let's just talk through why markets are rebounding. What are the key highlights there?
Yeah, so I think the main thing to talk about is obviously the tariffs, and we've had a pretty major pullback in the rhetoric that we saw in and around when he first announced them. So, at first there was the tariffs, then he went into the reciprocal tariffs, and then there was the kind of raising of one another war between the US and China. I guess where we are now, though, is we're seeing a number of countries speaking to the US about negotiations. We've got China saying, look, we're open to negotiations. We know Japan are in negotiations. So that's a bit better for market sentiment. And we're also seeing Trump himself pull back in some of the rhetoric that he's been talking about, things where he's been talking about the removal of Chairman Powell from the Fed, even things like that, he's started to pull back away from. So I think it's just allowing markets to have less headlines to focus on, and it's just allowed volatility to drop. So I know for us in the investment team, there's a volatility index that we would look at called the VIX. We're now all the way down to 22, and at the height of the tariffs, it was about 52. So we've pretty much more than halved. So, volatility across both equities and bonds has fallen as a result of this headlines kind of taking a back seat.
So certainly not as bad as what was anticipated somewhat about a month ago, a bit of a relief rally thanks to a combination of a pullback in tariff measures initially announced, comments from Trump and key trade partners on ongoing discussions about getting a deal done. And I suppose also being in the headlines this week has been on corporate earnings, which what we've seen for this year is that analysts are revising down earnings estimates because of tariffs, uncertainty, and the knock-on effects to corporate earnings. I suppose we've had the major US technology companies report this week, the likes of Meta, Microsoft, also Alphabet, Apple. What would be the key takeaways from your perspective?
Yeah, so I think what we've seen from those big tech names is that actually they've delivered earnings that were better than what was initially anticipated by the market. And also some of the comments they've made have also been maybe a bit more upbeat than what people had expected. So that's really helped drive some of the performance within the S&P 500. I also think what's important to note, what you were talking about with earnings expectations, is that although the market has moved down 2025, we're actually still seeing a positive number. So it's slightly lower than 10%, we're about 8-9%. But what we're also seeing is that actually markets think that tariffs are probably a one-off impact and one-off hit on the earnings. So if we actually look forward a year into 2026, those earnings expectations haven't really changed. So equity markets are still quite positive when looking forward, and that's why we've seen some of the good returns. Equity markets are able to look ahead into the future and say, actually, going forward, we actually still think that the earnings growth that these companies can generate is still intact, that thesis.
And it's similar to what we saw in the COVID period, early 2020 when earnings estimates were revised down, but people or investors looked beyond 2020 into 2021 where earnings were expected to rebound, and equity markets can actually look through that and drive higher. So certainly a similar trend.
Yeah, and we saw that with equity, through the period when tariffs first get announced, we see earnings kind of drop a bit, but actually it's more within the multiple of equity markets. They've actually shifted. But like you're saying, the fact that equity investors can look forward into the future, we've actually seen valuations move up a little bit from where they were, still lower than where we first came into the year. But that just kind of reflects, markets are thinking going forward, these companies can still deliver this type of growth. And I guess, looking forward into next year, what markets are thinking about is actually, can the US administration deliver those continuation of tax cuts that we're seeing? So that would be a positive for earnings for those companies.
Excellent. So just think about this week, we've had quite a lot of data on which gives us a sense of the US economy.
Yep.
We've had survey data, so looking at consumer confidence, looking at the manufacturing data and what business are reporting. We've also had some more what we call hard data, so actual numbers on the labour markets front and on the inflation front. How would you characterise what we're seeing on the survey data, but also on the hard data in the US?
Yes, we're getting somewhat of a distinguishing between the survey data and the realised data. So I guess in the survey side of things, it's maybe a little bit more negative, where consumers and also businesses are a little bit more negative when looking forward, just thinking we don't have 100% clarity on what the economic backdrop will look like because of basically all the headlines we've seen with tariffs. So are tariffs coming in, are they going out, what rate are going to be applied? So that just creates a little bit of uncertainty, and that comes through in the comments that we're seeing. But actually, if we look at what we're seeing in terms of the hard data, that's actually probably a little bit more positive. So we had US GDP, as you said, that was negative, but actually when we pour through the numbers, what a big negative contributor had been was actually imports into the US, and that's just the way the GDP calculation works. So because companies had been trying to get in stock ahead of tariffs coming in, that means imports are higher and pushes down that GDP number. Actually, the rest of the components were actually okay within that report. And I guess, as you mentioned, what we've just had a couple of hours ago at the time of filmings, the US labour data came in at about 180,000, ahead of what markets are expected. So we're not seeing any cracks really within the labour market data as of yet.
So that is 180,000 new workers added to the workforce. So that was better than what was anticipated.
Yeah.
And if we look at the unemployment rate, that was unchanged at 4.2%, which is historically very low and would suggest that the labour markets are still in good shape.
Yeah, and on the jobs being added, quite a lot of it's actually come from private companies rather than the government side of things. So still kind of indicates that companies are still willing to bring in new workers, and not kind of tariffs haven't got to the point yet where they're causing companies to think, actually, should we continue hiring people? So US firms still looking to employ people.
And I suppose, we've had the manufacturing PMIs out this week. What are those businesses saying about tariffs and the knock-on consequences for their businesses?
Yeah, so they're just, trying to reflect that the cost of production may actually be higher because of these tariffs. So when we look at the prices paid component, that's shifting up because basically tariffs are like a tax. But it's quite interesting if we compare what we've seen in the US to what we've seen European firms report. Actually, we're starting to see this divergence between could the US be more inflationary and Europe be more deflationary, because in Europe, what they're reporting is actually some of the lower energy costs that we're seeing might actually allow those firms to expand their margins that they're making, because some of the input costs are actually falling from the likes of oil.
Let's just finish on that point of just looking at inflation. So you talked about this contrasting idea of inflation being a bit firmer in the US, whereas the rest of the world's benefiting, the likes of the UK and Europe, that are big energy importers, benefiting from lower oil prices, lower commodity prices. We've had US inflation out this week. What were the details? Will it give the Federal Reserve enough scope to cut interest rates?
Yeah, so I think that is what we're seeing, that the market is pricing in more cuts now for the US, with that data just being a little bit more supportive for the Fed. So I think markets now are pricing for the end of 2026 about 5-6 interest rate cuts from the US. But in terms of where we actually are with the data, I think we're still seeing more supportive data within Europe, where we're much closer towards central bank targets in terms of what those inflation rates are like. So I think markets are still kind of pricing for the European Central Bank to be able to have lower interest rates than what we're seeing in the US and probably also here within the UK. So, you know, that's why we're seeing European bond yields trade so much closer to the lows than what we're seeing in the US and the UK, because basically the market thinks that inflation's more supportive in Europe, and that will allow the ECB to cut more than the Fed and Bank of England.
And I suppose that's a real positive for stock markets if central banks are able to cut interest rates.
Yep.
You've got lower bond yields that helps companies and households finance debt. So understandably, markets will take that well, and that's certainly what we've seen over the last couple of weeks.
Yep.
Thank you, Matt. Okay, well, that's everything from us. Thank you very much for watching, and have a great weekend.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.